Welcome to the weekly macro roundup. This video is brought to you by Michael Ogunremi, CFA. The content is sourced from Bloomberg, Reuters, Yahoo Finance, and other public newsletters. This week, it was reported that the U.S. economy grew by 4.3% in the third quarter, largely driven by consumer spending, government defense spending, and inventory accumulation. The economy continues to reel from a cooling labor market, but at a softening momentum, as the initial job claims number fell for a second straight week. Consumer confidence remained battered as it declined for the fifth consecutive month in December. U.S.-China trade tensions re-emerged, with the U.S. accusing China of deliberately hoarding its rare earth minerals and threatening to impose tariffs by 2027. In the equities market, Goldman Sachs and Citibank equity desks posited varying outlook on the equities market, with the former expecting more momentum in 2026 due to solid growth numbers, while the latter hold a cautious view due to the cooling labor market. Speaking of the labor market, it was a win for Trump as the $100,000 H-1B visa fee was upheld by U.S. courts, implying that U.S. technology companies will face more challenges hiring skilled foreign workers. This, of course, is good news for Canada, which may see influx of this skill set to its labor market. Lastly, on the U.S., Bloomberg estimated an 8% fall in the spot dollar index due to diversification away from U.S. asset. They expect this trend to continue in 2026. In China, global investors are increasing wagers on AI companies, supported by Beijing's push for tech independence. China imposed duties on some EU dairy imports amid a trade dispute. Locally, infrastructure borrowing is on track for its weakest year since 2019. The central bank reaffirmed its pro-growth policy, but signaled caution on aggressive stimulus, leaving benchmark loan prime rates unchanged. In Europe, industrial giants anticipate a solid 2026, driven by data center build-out and electrification. Germany saw a slump in car exports to the U.S. due to trade war effects. European construction shares gained on optimism around infrastructure stimulus and the AI boom. The EU also voted to impose tariffs as high as 45% on electric vehicles from China. Canada's migrant dash is slowing as the Prime Minister pushes to rein in immigration. The economy grew 0.1% in November, after a sharp 0.3% fall in October. Economists expect a soft fourth quarter and continued weakness into 2026. The Bank of Canada is uncertain about its next policy move, while the government may reconsider the foreign homebuyer ban in 2027. UK businesses ended 2025 feeling more upbeat after the budget spared them major tax increases. The economy slowed sharply in the second half of the year, with GDP growing only 0.1% in the third quarter. British consumers reduced savings as incomes were squeezed by a £6 billion tax rise. Japanese Prime Minister Sanae Takaichi sought to ease market concerns over fiscal policy by limiting reliance on debt in the draft budget. Japan aims to mobilize its $7 trillion household savings to support bond demand. The finance minister warned speculators about currency moves, while Japan and the U.S. are fast-tracking a $550 billion investment push. My top 5 developments for the week are the upside surprise in U.S. Q3 GDP, the gold rush driven by macro hedging demand, resurfaced U.S.-China rare earth tensions, Canada moving to revive its foreign homebuyer program, and Japan is seeking to mobilize household savings to support JGB demand. I hope you enjoyed the roundup for this week. Kindly remember to subscribe and turn on your notification for new posts. See you next week.